A family in Texas just started shopping for a used car. They found the one they wanted, a 3-year-old SUV listed at $28,000. They sat down with the dealer to talk financing, and the rate they were quoted was almost a full percentage point higher than what their neighbor got 6 months ago. Nobody told them why. But we know why, and it starts in a corner of finance you've probably never heard of. Let's decode this together. Here is what happened. The Federal Reserve just started asking major banks a very specific question. How much money do you have tied up in private credit? Private credit is basically lending that happens outside the traditional banking system. Instead of a bank giving a company a loan, a private fund does it. Think of it like a shadow version of your local bank, except with way less oversight and way less transparency. For years, this shadow lending market has been growing fast. Big investors loved it because the returns were higher than what they could get from regular bonds. But now, things are shifting. Investors are pulling their money out of these funds at a faster pace. The loans inside these funds are starting to go bad more often. And the Fed noticed. When the Federal Reserve starts calling banks and asking them to report their exposure to a specific market, that is not routine. That is a signal. It means regulators think there is enough risk building up that they need to understand how deep the connections go before something breaks. Now, here is the part most people miss. You might hear private credit and think, that has nothing to do with me. I don't invest in private funds. I don't even know what a credit default swap is. And that is fair. But the reason this matters to you is because of how interconnected the financial system actually is. Banks don't just sit on one side of the fence. Many of the biggest banks in the country have lent money to these private credit funds, invested alongside them, or provided them with lines of credit. So when the loans inside those funds start going bad, the pain doesn't stay contained. It travels back to the banks. And when banks start feeling nervous about losses, they do what banks always do. They tighten up. That means stricter lending standards, higher interest rates on consumer loans, more applications getting denied. And all of that hits regular people who had nothing to do with private credit in the first place. Wall Street is already taking this seriously. Traders have launched a credit default swap index specifically designed to bet against private credit. A credit default swap is basically an insurance contract that pays out if a borrower defaults. When Wall Street builds an entire index around the idea that these loans might fail, that tells you the smart money thinks the risk is real. They are not guessing. They are positioning. So let's talk about what this actually means for your wallet. Start with borrowing. If you are planning to finance a car, take out a personal loan, or apply for a home equity line of credit in the next 6 to 12 months, the window might be narrowing. Lenders are already adjusting their risk models based on what they are seeing in the broader credit markets. Let's put some numbers on it. Say you are financing that $28,000 used car. 6 months ago, you might have qualified for a rate around 6.5% on a 60-month loan. Your monthly payment would have been about $548. If rates tick up even 3/4 of a point to 7.25%, that same loan now costs you $558 a month. That is an extra $10 a month, which sounds small until you multiply it out. Over 5 years, that is an extra $600 you are paying just because the timing was worse. And that is a modest example. If credit tightens further and your rate jumps a full 1.5 points, you are looking at closer to $720 extra over the life of the loan. For a family already stretching to afford reliable transportation, that is real money. It is not just car loans either. Small business owners who rely on lines of credit to cover payroll or inventory could find those lines harder to renew. That means Some businesses slow down hiring or cut hours. If your employer is a small or mid-sized company that borrows to operate, this could eventually touch your paycheck. Here is the thing that makes this tricky. Private credit stress does not announce itself the way a stock market crash does. There is no red ticker scrolling across the bottom of your TV screen. It builds quietly. Loans go bad one at a time. Funds gate their investors, which means they temporarily block withdrawals. Banks quietly tighten their internal lending criteria. And by the time it shows up in the news cycle as a headline, the tightening has already been happening for months. We are kind of in that quiet phase right now. The Fed is investigating, Wall Street is hedging, redemptions are rising. But the average person checking their bank app has no idea any of this is happening. And honestly, that gap between what insiders know and what regular people know is exactly why we do this every week. So what can you actually do about this? If you are planning any kind of borrowing in the next year, the single smartest move is to get pre-approved now. Pre-approval locks in a rate for a set period, usually 60 to 90 days depending on the lender. That means even if rates creep up over the next few months, you have already secured your number. Beyond that, avoid taking on new debt right before you apply for something big. Every new credit card, every financed purchase, every balance that creeps up makes your application look riskier to a lender who is already feeling cautious. Keep your credit utilization low. That means if you have a credit card with a $5,000 limit, try to keep the balance under $1,500. Lenders look at that ratio closely, and in a tighter lending environment, it matters even more. Now let's talk about what to watch over the next few weeks. First, keep an eye on bank earnings reports. The major banks report quarterly, and when they do, listen for any mention of increased loan loss reserves. That is, money banks set aside because they expect some loans to go bad. If those reserves are going up, it confirms the tightening trend. Second, check your own credit score this week. You can do it for free through your bank's app or through a service like Credit Karma. If your score has dipped below 700, now is the time to figure out why and fix it before you need to borrow. It takes 5 minutes. Third, watch for any news about the Fed releasing results from their private credit review. If they find that bank exposure is larger than expected, that could accelerate the tightening. Here is your takeaway for this week. Check your credit score today. Not tomorrow, not next week, today. If you are anywhere close to needing a loan in the next year, knowing your number right now gives you time to improve it before lenders get pickier. A 50-point improvement in your credit score can save you thousands of dollars over the life of a loan. That is one of the highest return activities you can do in under 10 minutes. Quick reminder, everything we cover on Money Decoded is for educational purposes only. None of this is financial advice, and we're not licensed financial advisors. Before you make any money moves, do your own research and talk to someone who knows your specific situation. If this was useful, hit subscribe. We do this every week. That's the Decode for this week. We'll see you in the next one.